Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the October investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the markets and investment universe that you need to know right now. Bob, we missed you last month, although Michael filled in admirably. How did your sabbatical go?
It went great. It was nice to take some time off from work, disconnect for a little while, and also, let the team lead on the investment front. And everything I heard, they did a great job. So it was a nice benefit, and I enjoyed the time off.
Nice. Awesome. So the first day you were gone, we had a pretty severe market pullback for one day.
Yes.
So we were thinking we were going to have to call you back on day two, but things stabilized. How are the markets doing year to date, Bob? I know it's been a strong year in a lot of different categories. Can you put some meat on that bone for us?
Yeah, the markets are doing well. So I'll just run through some numbers. Today's October 2nd. So as of October 2nd, MSCI USA, so US total stock market, year to date up 20%, and over the last month up 1.18. So last month's been fine for US stocks, up 1%, and year to date up 20. So great year for the US market. Looking overseas to developed international, you have the MSCI World ex USA up about 12.5% year to date, and almost 1% over the last month. A little weaker than the US, but still overall healthy return, 12.5% year to date. Emerging markets, there's a story here to unpack maybe a little later. Year to date up 17%, and over the last month up about 7%. So US up about 1, international developed a little less than 1, emerging markets up 7. Maybe we'll put a pin in that and come back to talk about what's going on there, but a healthy return of 17% year to date in emerging markets. Bonds, Bloomberg US aggregate is up about 5% year to date, 1.6% over the last month. So healthy return from bonds. And that rounds it out for stocks and bonds. So it's been a good year for stocks, good year for bonds across regions. US is leading, but overall strong returns year to date in the last month. It's been strong as well.
So do you want to get into the emerging markets? I think it's basically a China story, right? You and I have been exchanging some emails and articles about that. What's going on in China? Because I guess the market there has gone through the roof over the last, couple of weeks?
Yeah, it was mid-September. So the backdrop is it's been a tough about 5-year stretch for China. The government has not been, call it friendly to investors. There was the whole thing with Jack Ma, who was in hiding with Alibaba a couple of years ago, and they've had anti-competitive actions and just overall have not looked that supportive of financial markets. And meanwhile, their growth rate has been slowing. Their demographics are unfavorable, you could say, from their one-child policy. So it's just been a pretty murky picture. And I think investors have shied away, and the market has not done well. And the stock market's gotten really cheap. And then in mid-September, they announced a boatload of policy changes that are all very stimulative and supportive of financial markets, ranging from allowing companies to borrow money to buy back stock to helping people with home purchases for real estate. So it's like the bazooka analogy that we had in '08 when Paulson came out with a big stimulus plan, where they're really backing markets. And I think the market's response is positive, of course. The Chinese market's up about 30% since then, and this is only over like 2-3 weeks. I think there's two things. One, just the policies as they stand are strong, but it's also more, even like in the US, like the words mean a lot, and the action as well, seeing that it's like, okay, they're taking this seriously. It's not a administration or government that doesn't care about financial markets. It's now on their radar, and they are behind the stock market. When for the last 5 years, it seemed like they didn't really care. So all of that has really been a catalyst, and the stock market's dirt cheap. It's trade in single digit PEs, like around 9 times earnings, around book value, like 1.1 price to book. So you have a really depressed market with a ton of bad news baked into it, and then you just get this big spark of positivity. And it doesn't mean there still aren't problems there. Like they're not solving the demographic issue overnight. But it's a good change of direction because the look on China had been pretty bad. And with markets, it's not good or bad, it's better or worse, and it got better. And as a result, markets reacted.
So there's been a lot of people talking about this clip of David Tepper on CNBC recently, just talking about buy everything in China. For those of you who don't know who he is, besides being, I think, the horrendous owner of the Carolina
Yeah.
Panthers football franchise, he is a pretty brilliant investor. And in 2010, he ignited the Tepper rally on CNBC by just talking about, at that point, I think it was U.S. equities, and we were off to the races. And so people are wondering if this is a parallel moment for China. But he basically very aggressively said, I'm going to buy everything. You should be buying everything in China. Did you see the clip?
I did, and I wouldn't disagree with him on that front. But you don't often get the setup here with the valuations being as low as they are and good news. Normally, when there's good news, prices are high. When there's bad news, prices are low. And there had been so much bad news in the Chinese market that the prices got really low. When you have this good news, it's lifted, but they're still pretty depressed. So they're it probably is a good time to be buying there. We're not going to be, we're not, he runs a hedge fund. We're not hedge fund active investors. We have some exposure to emerging markets and we're happy with it. We're not going to increase it. But it does look like that there's, reasons to be excited about emerging markets right now.
What about risk controls, Bob? So he kind of brushed that question off when he did get it. And you alluded to the fact that we are not increasing our China exposure. We're not increasing our emerging markets exposure, despite the fact that you just said it's a great setup, right? So why is that? I suspect it has to do with risk controls, long-term asset allocation, but maybe for our listeners who might be tempted to plow into China and increase their exposure and go quote unquote all in. What are the downsides to that? How do you protect yourself?
Well, I guess there are two sides to China that we've talked about the positives. But on the concerning side, they've basically built their economy as the low cost producer for the world. Like your iPhone is just probably made in China. I look at my eyeglasses made in China. And it's tough to have an economy grow and say develop a middle class if your call it value proposition is being the lowest cost producer in the world. Because how do you get those wages up to what we would call like a middle class wage in the US and not have fill in the blank country, Vietnam, India, Mexico, take those manufacturing jobs. So they might be a little stuck with that being their economic consumption model. Another way of putting it, and Tepper in the interview even acknowledged this. What they need to do is transition their economy from exports, like I'm talking about, to consumption, internal consumption. So you have a middle class who's consuming, buying goods and services, and that's driving the economy rather than basically making a bunch of stuff for the rest of the world. And that's been their problem for the last 15 years. And I frankly still don't see a solution to it. You pair that with the demographics of the one child policy and how you've got from the generation when that policy was in place, that's more of the demographic of peak working years, and they have kind of a bubble above. If you there's these demographic charts that show the head count, a lot of people who are more exiting the workforce with fewer people who are in the workforce. So there's good and bad. It is cheap for a reason, and whenever people get over their skis excited about something, I'm sorry, I bring the wet blanket out, and there's risks to China for sure. So it's gotten better. Have some exposure, but be careful.
Just in general, that market and the emerging markets in general have volatility levels well above what you see in the
Yes.
U.S. and their normal drawdowns are, I think, close to double what our normal drawdowns are.
Yeah, a lot of risk there. So with emerging markets, we keep it about market weight. So overall, maybe 10% of your equity in emerging markets, not just in China. China's maybe 25% of emerging markets. So call it 2.5% of your equity in emerging markets because the volatility there is much higher. Have some exposure, but not too much.
What do you think, Bob? Wealthy behavior will ever get so big that we ignite a stock market rally like Tepper did in 2010?
I don't think so.
I don't think so either. So he's interesting, though. If people recall, I interviewed Mike Santoli on this podcast and asked him a question if he had access to any one investor who he could just constantly pick their brain. He did pick Tepper. So
Yeah.
he does have a lot of credibility in the industry and a really strong track record and definitely got people's attention recently. So, Bob, the other thing is you and Michael had a market outlook webinar yesterday that I think we had a lot of registrants for. Those are typically our most popular events. I think we do 2 market outlooks a year. This was the fall market. Not to ask you basically to press play and go through the hour content, but for those who weren't able to join, what were your main takeaways, or what do you want the main takeaways for them to be?
Yeah, I'll just try and touch on some of the key points. We've talked about Fed policy a lot on this podcast, so we went over that and the recent rate cut. One new piece of information that we shared are signs of consumer weakness. So delinquencies on credit cards and auto loans have been rising over the last couple of years, and they're now at levels we haven't seen since coming out of the financial crisis in '08. So it was declining, but we're back at like 2010, 2011 levels. So the highest level for delinquencies on credit cards and auto loans that we've seen in about 13 years. And that goes hand in hand with unemployment ticking up. So unemployment is up to about 4.3% from a low of 3.4. So that 0.9% increase equates to about 1.5 million people out of work who are looking for work. So it's seeing those signs of weakness. That's where the Fed is more balanced in their approach, hence the rate cuts that we've seen and probably more to come. So that was kind of one big picture takeaway. Second, looking at asset class valuations, U.S. stocks are a little expensive compared to history, whereas U.S. bonds are a little cheap compared to history. So that by itself might lead you to think, okay, favor bonds over stocks. But then we have a caution sign saying, be careful, stocks tend to run. And when you have the U.S. stock market hitting a new all-time high, something that some journalist or TV might point out as, oh no, look out below, the stock market's at a new all-time high. It actually does better than average. So there's a phenomenon called momentum or trend in markets, and winners keep winning on average, and losers keep losing. So while the stock market has positive momentum, you have to be careful as a value investor and not say, oh, it's expensive, time to cash out. So the takeaway there is bonds are no longer ugly. Like they were pretty ugly 5, 10 years ago. So get your bond allocation right. Have what you need there. Don't avoid bonds, but be balanced in your approach. Still have a healthy exposure to the stock market.
So,
And
Bob, just to jump in there real quick with bonds, when you say get your allocation right, I think you're talking more about the overall percentage in the portfolio.
that's
But are there particular areas of the bond market? Is there a duration range that you guys like or are uncomfortable with on the other side?
it's within bonds. So yes, I'm talking about getting the percentage right, the asset allocation
Yep.
right. Like if you're a retiree, so years ago, retirees would say, oh, I'm going to buy utility stocks for my income. And that might have been a decent tool then, but now I buy bonds. Less, I'll talk about duration, but more I would focus on credit quality.
Okay.
Credit spreads are pretty tight. So and you see some people chasing yield.
What does that mean first, Bob? Credit spreads being tight or wide? What's the
So
risk or
there's
benefit there?
credit ratings like ranging from AAA, meaning the highest, basically risk-free, all the way down to B's and C's and D if you're defaulting. So if you think like U.S. Treasuries are high quality, AA, AAA, but then if you get to junk bonds, which are double B and below, you're taking more credit risk because a bond you're basically lending an entity money. They're paying you interest. You hope to get paid back. U.S. Treasury, they're reliable. They should pay you back. A less credit-worthy borrower may not pay you back. What do markets do? For the less credit-worthy borrowers, they pay more interest. So some investors I see look at bond funds and what do? Well, what's the yield? Is the first question. And what do? They buy the fund with the highest yield. What's under the hood? Junk bonds. What's going to happen? What might happen if markets decline, credit spreads widen, prices go down, defaults pick up, your bonds wouldn't behave the way you want them to be. So it's be careful with credit risk in bonds. So more look for double A, triple A, even single A is okay, but keep the credit quality high quality is the main focus there. As far as duration, intermediate term is a good place to start. If you're trying to match liabilities, like if you have expenses coming up, say, in 1 or 2 years, then buying bonds with a maturity of 1 or 2 years could make sense. So it's kind of a whole nother thing we could talk about, but asset liability management, where basically the duration of your bonds should about match the duration of your liabilities. So if you have very long-term liabilities, longer-term bonds, shorter-term liabilities, shorter-term bonds.
Great. So sorry, keep going. I know I hijacked you there a little bit from the webinar recap, but I did want some more color on the fixed income, and I appreciate you doing that.
Yeah, we also talked about diversification in the index and how there's concentration with the whether you talk about the Magnificent Seven or top 10 names in the S&P, how they've gotten pretty big, and it's important to diversify so you're not overexposed to the top. And then probably the funnest topic that we walked the tightrope was politics. And basically every election cycle we'll have a handful of clients who either before the election, I'm afraid of this outcome, whoever the candidate is that they don't want to win. If so and so wins, I'm afraid I want to go to cash. Or after the election, that their candidate did not get elected and they want to go to cash. So to get ahead of that a little bit, we had some data, and I kind of shared a disclosure that we're looking at politics through the lens of only financial markets and the economy. I know there's a wide range of key issues, and I don't mean to discredit those, but that's, as investment advisors, our job is to look at market outcomes. And the bottom line is markets have done well under Republican administrations. Markets have done well under Democratic administrations. And we have some slides on this, but when you look at the makeup of Congress, all in all, markets still do well. So you can pick through it, and it's not to say it's all equal and it doesn't matter, but do you go to cash? No. And an analogy I was thinking of this morning, I remember, I think it was last election cycle, I shared a slide like this with a client, and he's an experienced investor, probably about 75, Midwestern guy, and he said, "Bob, you don't have to worry about me in politics. I've made a lot of money under Republicans, a lot of money under Democrats. I know it's fine. Whoever wins, wins, and I'm not going to touch my portfolio." And that kind of hit the nail on the head. That's the message I'm trying to deliver. That yeah, politics do matter. I'm not going to get into your politics, but keep your politics and your portfolio separate. That markets have done well under Republicans, they've done well under Democrats, and try to not react to election outcomes, whichever way it may go.
Yeah, no, that's a great recap. I appreciate you sharing that. And I would encourage people when they see those announcements for our webinars to sign up. And I think even if you ultimately can't attend, you will get an email recapping the conversation. One thing you touched on was diversification in the S&P, and sorry, maybe a lack of diversification in the concentration. So we've been, I would say, directly and indirectly telling people to broaden out their portfolio, particularly their stock market exposure, into other areas globally, as well as small and mid caps. And I sent you a note that I saw where a large percentage of the small cap index, those companies were unprofitable.
Yes.
And that reminded me that, we've talked about small cap investing as a whole, but there's definitely a side of the small cap market that we like, and there's definitely a side of the small cap market we tend to have more concerns about. And I'm talking about the kind of the growth value split, particularly within small cap. Can you walk people through that? Because I would hate for them to diversify into an area of the market with incomplete picture of where we prefer those assets to go.
Yeah, it's a good question and topic. So first, just to set the stage, what are small caps? And it's by definition companies with a low price. So market capitalization is simply shares outstanding times share price. So it's what's the price to buy the whole company. Small caps, rule of thumb is companies under a market capitalization of $1 billion. So the total value of the company is less than $1 billion. So you're looking at companies with a low price. when you start in that universe, what are you going to find? And to what you said, Sammy, I believe that the number in the study was 42% of small cap companies don't have earnings. They have negative earnings. They're losing money. And it's a much higher number than it is for mid cap or large cap companies. And that makes sense because if you're not making money, should you have a high price or a low price? Probably a low price. So you end up in small caps. So does that mean small caps are bad? And there'll be a lot of articles, saying things like this, like, look out, small caps, 42% don't make money, don't own them. We're aware of that. When you look at the data, Gene Fama, professor at University of Chicago, and Ken French, a professor at Dartmouth, did a study years ago where they looked at market returns, where you dissect the market by large and small and value and growth, and growth is more expensive. What they found was that the best style was small value, and the worst style was small growth. So small is kind of split. The small, expensive, and unprofitable, that's the worst sandbox to be playing in, looking at, say, 100 years of data. Small, cheap, and profitable is the best sandbox to be playing in. So the characteristics of the companies in small caps definitely matter. And that's where indexing has its flaws. Some people say, oh, well, just buy an index fund. And, first question I'd say is, well, what index fund? And it gets nuanced. Like, well, do you want small cap exposure? If you do, probably don't want to just buy a Russell 2000 index fund because you're going to have both the small unprofitable companies and the small profitable companies. We work with actively managed strategies that weigh those considerations and overweight the profitable companies and exclude, or at least severely underweight, the unprofitable companies.
Great. No, I really appreciate that overview, Bob, and also recapping the webinar and what's been going on in China and the markets overall. Is there anything else that your team is focused on, either that's going to make its way into the portfolio or just interesting questions that you feel like investors would love to hear about?
A quick in the weeds update on taxes. I know that's something that people care about. And just high level, we are getting more and more tax efficient. There's a lot of levers to pull, ranging from custom separately managed accounts with tax loss harvesting to utilizing ETFs that do not distribute capital gains. And then even in the mutual fund world, mutual funds seeing the pressure from these competing products like SMAs and ETFs, mutual funds are finding, I'll call it, creative ways to operate more tax efficiently and minimize capital gain distributions. So there's a lot of work behind the scenes on that front. We're also doing a better job than ever proactively taking losses, tax loss harvesting. So just a lot of work under the hood on being tax efficient, because when you think about managing money, focus on what you can control. And what can we control? We can control taxes. We can't control politics, but we can control taxes. And like I said, it's an in the weed thing, but it's something that we're working on a lot, talking to the managers about, and there's a big emphasis to help clients keep more of what they return through tax efficient investment management.
Good. Yeah. People love paying taxes, Bob. So anything you can do to help them pay more. Yeah. Just kidding. So I guess I'll take us out on this question because, and I think I have this feeling, there's a feeling that the ETF structure is more tax efficient than mutual funds. But you're saying that what's been going on in the ETF space has pushed the good mutual fund managers to, improve the tax efficiency of their funds and try to level out the playing field.
Yes. So some of the rules that allow the ETF structure to be more tax efficient are not specifically prohibited to be used in the mutual fund structure. They just haven't been. So innovative asset managers are kind of taking the ETF playbook and using it in the mutual fund structure. The biggest example is if you have a stock that has a large gain in an ETF, you can kind of ship it out to a third party, an authorized market participant who takes it, and it takes the capital gain off your book. And there's a mechanism for mutual funds to do that as well. One of the managers we work with, DFA, took about $20 billion of capital gains off their book this year through distributing shares in kind to third parties. So it's things like that take a lot of tax attorneys and work behind the scenes, but ultimately benefits the end investor.
All right. No, I appreciate that, Bob. Thank you for that recap and joining us today. I know our listeners love hearing from a chief investment officer overseeing about $3 billion and what you're thinking about the investment universe and the markets. So thank you for your time.
Thanks, Amy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.